So today's topic obviously is mentioned as apartment assessments. And I first have to start with a disclaimer that the Department of Local Government Finance does not get involved in individual property tax assessments or appeals. The following information should not be construed as legal advice, and any legal questions or issues should be directed to your county attorney. So having said that, today we're going to look at several aspects of apartment assessments. We're going to first start with Indiana code provisions. We're then going to talk about assessment practices, low-income housing, frequently asked questions, and then open it up for questions. And I've purposely tried to keep the presentation brief so that we can have questions at the end, because that's where I find I learn a lot is from the questions that are submitted. So for those of you that I've dealt with frequently, I will often refer to the Indiana Code or the Indiana Administrative Code because that's the law of the land is passed by the General Assembly, and then the Indiana Administrative Code is our rulemaking authority that allows us to provide guidance and interpretation of the legislation that's passed by the General Assembly. So having said that, the first code citation that is applicable for apartments and assessments of the apartments is Indiana Code 6-1.1-4-39. And you can see there that it's applicable for residential accommodations for periods of 30 days or more, and that has more than 4 rental units. And that's a key that will come up in a couple different places, but it's more than 4 rental units. So you can interpret that to be, say, five units or more. Anyway, apartments are assessed using the lowest valuation of the 3 approaches: the cost approach, the sales comparison approach, or the income capitalization approach. For rental properties that have at least 1, not more than 4 rental units, and mobile homes assessed under Indiana Code 6-1.1-7, the gross rent multiplier method is the preferred method. Certainly there are other methods to evaluating properties, but for those rental properties that have 1 to 4 units, it is the gross rent multiplier method is the preferred method of valuing those properties. If a township assessor or a county assessor meet with or agree with the taxpayer before the notices of assessment are sent out that they're only going to use 1 of the 3 approaches to value, that is certainly appropriate or acceptable to do. But the key is that that must be done before the notices of assessment are sent out by April 30th. So the legislation gives the department the ability to adopt rules. And if one of the key things is if a taxpayer wishes to have the income capitalization approach used in terms of using their information, the taxpayer must submit the necessary information or profits and expenses, income and expense information to the assessor not later than the assessment date. Key here is, however, the taxpayer is not prejudiced in any way and is not restricted in pursuing an appeal if they do not submit the data by the assessment date. Certainly, we'd hope they would get the information in as soon as possible, but sometimes it doesn't happen, and that's the way it goes sometimes. So they still, even if the taxpayer does not submit their income and expense information, they still can pursue an appeal if they so decide to do so. The information is confidential, so if you do receive income and expense information, you must treat that as confidential, and that includes information for earnings, income, profits, losses, or expenditures of personal property. For low-income rental property, we'll talk about that in greater length in a little bit. The true tax value is not determined using those 3 approaches. we'll talk about in a minute, the specific valuation process for those low-income properties. A couple of years ago, there was legislation passed that would restrict or make sure that the assessor does not do anything outside of the DLGF's rules and regulations. And you can see the assessor shall use the department's cost schedules without additional modifiers, adjustments, or other trending factors beyond the location cost multipliers that we provide. And the use of locally developed cost schedules or location cost multipliers and market or trending adjustments is prohibited. Even if the valuation for a property goes up by 1% or 2% or 3%, whatever the amount may be, the assessing official still has the burden of proof to establish that the assessed values using the lowest valuation approach is correct. So I know there's been legislation in terms of if the assessed value goes up more than 5%, the assessor has the burden. But if it goes up 1 or 2 or 3%, whatever it may be, the assessor still has the burden of proof in terms of if an appeal were filed by the taxpayer. And if the taxpayer requests it, the assessor is responsible for providing an explanation to the taxpayer on how the assessed values were derived or calculated. For Section 42 properties, the federal income tax credits may not be considered in determining the assessed value. And like I said, we'll talk about in greater length in a little bit how Section 42 properties are assessed. Indiana Code 6-1.1-4-41 talks about the assessment of low income rental housing. And by this, it talks about using or not using the federal income tax credits under Section 42 properties from the Internal Revenue Code. For assessments after February 28, 2006, the true tax value of low income rental property is the greater of the true tax value using either the income capitalization approach or what results in the gross annual tax liability equal to 5% of the total gross rent received from the rental of all units for the most recent taxpayer year. For assessment dates after December 31st, 2017, the true tax value of low income rental property that offers or is used to provide Medicaid assisted living services is equal to the total true tax value that results from the gross annual tax liability equal to 5% of the total gross rent received for those living units. And you can see the total true tax value shall not include gross receipts from or value of any assisted living services provided. There is an exemption for low-income housing, and that specifically is found in Indiana Code 6-1.1-10-16.7, but that allows Section 42 properties to be exempt if, and the key word here is if, the owner of the property has entered into an agreement to make payments in lieu of taxes or a pilot program. So there can be some situations where Section 42 properties are exempt from taxation. However, there must be a pilot program in place. So how do we take those Indiana Code provisions and put them into practice, so to speak? So this will be a reiteration or restating or just simplifying what's in the Indiana Code. Sometimes you read the Indiana Code and it seems hard to understand, so I tried to just make it as simple as possible. So basically start off with assessors must use best value apartments using the lowest of the three approaches to value, the cost, sales, or income approach. Mentioned before that the gross rent multiplier is the preferred method for property having 1 to 4 units, but certainly the assessor could use different valuation techniques, but the gross rent multiplier is the preferred method of valuing those properties. Talked about that the taxpayer and the assessing official may agree to using only one approach, which is fine. However, they must do that before the notice of assessment is sent to the taxpayer by the assessor. If the taxpayer wishes to have the income capitalization method or the gross rent multiplier method used, the taxpayer must submit the income and expense information to the assessor not later than the assessment date. But if they do not, they still have the right to file an appeal. All the information that's provided is confidential, so make sure you adhere to not releasing that information. The true tax value of low-income rental property is the exclusive method, and we'll talk about that in Indiana Code 6-1.1-4-41. And then also in terms of the assessor sending out the notice of assessment, we've created a form 11A, that is specific for the assessors to use for apartment assessments. And that does have a place that shows the 3 approaches to value and what those amounts are. And it shows then obviously what the lowest of the 3 approaches to value would be for the property. Talked about the legislative change that the assessor uses our cost schedules without any independent or separately locally developed cost schedules or location cost multipliers or market or trending adjustments. The assessor has the burden of proof and showing that in terms of the 3 approaches, and also the federal income tax credits awarded under Section 42 may not be considered in determining the assessed value of low-income housing properties. So for assessments, using, we talked about this a little bit a few minutes ago, is for Section 42 properties, it's determined using the income and capitalization approach, or that results in the gross annual tax liability equal to 5% of the total gross rent received from the rental of all units. So in this situation, what the assessor must do, obviously, to determine what is the tax liability is they'd have to get the information in terms of the rental of all units, and then also look at the tax liability, the tax rate, to determine which is the greater of the 2. Talked about the Medicaid properties, so I won't belabor that point. Low-income housing. So there are 2 main types of low-income housing properties, Section 8 and Section 42. And I'll start off with Section 8. And this is Section 8 properties are primarily looking at or targeting the income, the individual versus the property owner or the developer. And they're what's called housing choice vouchers. And this, in essence, allows, the program allows the eligible households to pay the rent on privately owned homes or of their choosing or apartments. And a family receiving a voucher must pay at least 30% of its monthly adjusted gross income for rent and utilities. And these programs are generally administered through local or city housing authorities. There is a state agency, the Indiana Housing and Community Development Authority, the IHCDA, that helps administer and work with the various housing agencies throughout the state. They contract with local community programs to provide case management, and also if there are any wait lists for the HCV program. As you can see, there are over 4,000 families are helped by this voucher program to pay their rent each month. And the eligibility is based on the family's household income. And it covers a portion of the rent. The voucher covers a portion of the rent, and the tenant is expected to pay the balance. And how much of that is obviously dependent upon the individual or the tenants, but it's generally going to be between 30 and 40% of their monthly adjusted gross income for rent and utilities. So how do you value a Section 8 property? Well, like other income producing properties, you do the income approach, and that's done by estimating the net operating income, which is gross income less operating expenses, and then presenting or converting that to the value by dividing it by the capitalization rate. Replacement reserves are considered an allowable operating expense, and tax credits may not be considered in determining the operating income of low-income housing property. The other low-income housing type of property is Section 42, and I think that gets most of the attention if you're to ask or poll individuals, about low-income housing properties. They probably have heard more about Section 42 properties versus Section 8 properties. But what the Section 42 program does, it has basically a tax credit program, and this is through the Internal Revenue Service. And basically it's to provide a tax credit to property owners and developers to create affordable rental housing. And in exchange for the tax credit, the property owner must agree to restrict occupancy to program eligible households, to follow program rent restrictions, and to keep the housing safe and sanitary. Every state has a designated housing finance authority. We've already talked about the IHCDA, and that's the state agency that is responsible for overseeing the program in Indiana. The IHCDA conducts compliance audits, inspections, and annual reviews for all Section 42 properties in Indiana. They also maintain a list of all Section 42 properties. So if you go to the web link, you can see all the Section 42 properties throughout the state or in your individual jurisdiction. In order to be eligible for a Section 42 housing tax credit, there are a couple of things. First, the household must be income eligible. And second, the household must meet the program's student status rule. And we'll get into a little bit more depth in a minute or two about the status of the students and why or why not that's important. So the income limits are based on the number of individuals living in the unit. And this would include related or unrelated individuals, and could be also includes individuals that may be away from the household. Say if someone one's at school, also unborn children or children in custody, joint custody agreements, as long as they reside in the unit at least 50% of the time. And it also includes foster children or foster adults. There are two special rules related to this, however. First is that the household members get to choose whether or not to include a member who is permanently confined to a hospital or nursing home. And then military members that are away on active duty are counted only if they are head or co-head of the household, or if they leave behind a spouse or dependent child in the unit. There's a note that if you have live-in aides and guests, they are not included in the count for the household size. So once the household size has been determined, be it 1, 2, 3, 4, 5, however many people in the household, that's used to determine the income limit to apply. And the United States Department of Housing and Urban Development, or HUD, they annually release program income limits based on household size. And then each county has its own set of income limits. So typically program, Section 42 program units are households at 30%, 40%, 50%, or 60% of the area median income. And that area median income obviously is dependent, say Indianapolis, Marion County, the area median income may be a lot different than the Benton County area median income or the Ohio County median income, whatever it may be. So once that amount is determined, the unit will be designated for occupancy at the level, and it can be occupied by a household with an income limit below an income below the limit. So for example, if you had a unit designated at 60% of the area median income, they could have a household at 30% of area median income move into it. But conversely, you cannot have a unit at 30% and have the household at 60% of the AMI move into it. So how do you determine, or what is used to determine the income eligibility? Well, he looks at all sorts of different things, such as earned income, employment, how much is your salary? If you have unearned income like Social Security, child support, and then also if you have asset income, say you get interest on bank accounts. The total household income from all household members from all sources must be at or below the income limit at the time of the move-in. So obviously it's going to be a case-by-case situation. Do you have a mother and a father and 2 children? Do you have 3 separate individuals living together? What is comprised, or who comprises the household, and what is the total household income at the time they move into the property? So for example, if a household has 4 members and they want to move into a unit designated at 50% of the area median income, the property manager would have to determine the household income and make sure that it is at or below that 50% income limit. So I mentioned a minute ago, talking about student housing. And so the Section 42 program was designed to prohibit the use of the program to create dormitories or other student housing. If you think of college or university towns, certainly if you were to have, students moving in, their income levels would probably be, the area median income would be probably pretty low. And so the Section 42 program was designed to mitigate or reduce dormitories or other student housing from qualifying for Section 42 designation. As individual is considered a full-time student if he or she was at the school for parts of 5 or more months out of the calendar year. So if somebody says, am I a full-time student? Well, there's your definition. Were they at the school for five or more months on the calendar year? The individual must apply for Section 42 at the housing at the property which they wish to reside. So if I wanted to go to XYZ apartment complex or housing units, I would have to apply at that housing unit. And then that's when the application process takes into account the income. We talked about the income generated, and then also whether or not the students is one of the individuals student, what is their status. Once the eligibility has been verified, then the household must sign a tenant income certification, certifying that all the information is true and correct. Once they're accepted, they enter into a lease agreement. And if tenants are responsible for paying their own utilities, then the property must use a utility allowance. And we'll give an example here in a second. And that is an estimate of the average monthly utility cost for the unit. and the actual rent then that can be charged must deduct the utility allowance. So, for example, say you have a household in a 2-bedroom unit designated at 50%. The HUD chart says that the limit for a 2-bedroom unit at 50% in that particular county is $550, and the utility allowance is $150. So the maximum amount of rent that can be charged to the household is $400, which is the $550 rent limit minus the $150 utility allowance. There may be situations where you have both a Section 8 and a Section 42 property combined. You can see Section 42 properties cannot refuse to accept Section 8 vouchers. However, the voucher holders must meet all the other eligibility and tenant requirements. We talked earlier about Section 42 properties could be exempt if the owner has agreed to payments in lieu of taxes, the pilot program. And in terms of how the value of Section 42 apartments is derived, it's the greater of the income capitalization approach, or that results in the gross annual tax liability equal to 5% of the total gross rent received. We get, as a state oversight agency, you can imagine we get a lot of questions from assessing officials and from taxpayers. And so I went through my emails for the past year or two and found several apartment related questions. So I just wanted to go ahead and start with some of the frequently asked questions. So the first one is, an apartment complex is 100% finished or completed as of January 1st, 2025. However, the apartment complex does not have any tenants as of January 1st, 2025, thus no income. Under the code provision, what value would you assign, given that it's the lowest of the three? Well, a taxpayer can't come in and say, well, we don't have any income, so therefore we want the assessment to be zero. That would not be acceptable. Since there's no income or expense data available, then that would leave the other two approaches to determine what is the lowest amount. And then we would also recommend or suggest that the assessor note on the Form 11A for the income approach that there was no information available. Will the cost approach always be the lowest? Generally speaking, yes, it will be the lowest. However, there may be situations where it isn't. Maybe there's a property with a high vacancy rate and the income and expense information results in a lower amount. So generally you could think of it being the lowest, but not necessarily in every case. So if the cost approach is the lowest approach, is it reasonable to assume that the assessed value would decrease over time? Generally speaking, it could decrease over time due to depreciation, and assuming that the property owner does not make any significant changes. However, we've seen in some situations, some counties, where the assessments under the cost approach did increase, and that's primarily due to increases in the land portion of the assessment. But the assessed value may not necessarily decrease if there was a situation where say the effective age of the property was changed or updated because of a new roof being put on, or new siding, or new windows, something that would cause the effective age to change does not, would not necessarily decrease the property's value through the cost approach. Does Indiana Code 6-1.1-439, what we talked about at the very start, apply to nursing homes? And the question is, technically they are renting a room for more than 30 days. And does this also apply to assisted living facilities? And then if so, do you require the Form 11A to be sent out for those properties? So nursing homes and assisted living facilities do not fit under the apartment statute. Medicaid and Medicare largely pay for resident stays, especially in some nursing homes or assisted living facilities. So the income approach doesn't make sense for those facilities, especially Medicare rates for each person sometimes are over $500 a day, and Medicaid is over $200 a day. We have roughly 100 multifamily facilities with 5+ units that span multiple parcels. The assessor's office put in a request with the auditor's office last September about having those parcels combined into a single parcel for taxation purposes, but as of today, that's not happened. How should the assessor's office handle it if the parcels have not been combined by the January 1st, 2025 assessment date? And in this situation, the legislation and pre-existing statutory language does not require that the multifamily units be under a single parcel. Certainly, it makes it a lot easier if the units are under one parcel, but it's not a requirement, and the law still applies regardless of the number of parcels involved. Would the income approach to valuation and the sales approach be reflected only on one parent parcel for the facility, with the other child parcels holding zero value for those approaches? For the cost approach, what happens if the improvements span multiple parcels? Should that value be broken up somehow across the parcels? So this, again, is not impacted by whether the units are under a single parcel or not. The income approach is based on the estimated income for the entire property as a whole, and the value determination would take a number of different factors into account, in terms of occupancy ratios, market rent based on the median income, the rents for the apartment, gross income multipliers, all that stuff. What about mixed use facilities with apartment use? So we have a number of facilities with both multifamily and retail use. Sometimes they also contain a parking garage, and they assess the retail properties based on the income approach. And if you start mixing, what happens to those? And could you split it up? And then also, how would you display that information on the Form 11A? So this happens or occurs, I know, in several counties throughout the state in terms of mixed use properties. And for determining the income approach for mixed use properties, the valuation formula would only be based on the residential units within the property. So when you have a mixed use property and you're trying to determine the amount for the Form 11A, it would only be for those apartment units or rental units. In terms of Indiana Code 6-1.1-4-41, what documentation should they provide that they are Medicaid assisted low-income housing? We're not aware of any specific document per se, but certainly if someone is Medicaid assisted, they would have that documentation that they can provide. The IHCDA may also be able to provide that information, or they may be able to provide suggestions on documentation to confirm eligibility. And one of the things I frequently will tell people is you may want to check with your county attorney for specific legal advice guidance, because they are there to represent the assessor, and they would certainly know or be familiar with the situation and could advise you accordingly. So this is a couple questions boiled down to one. So start off with the sale price of $60,000 divided by the monthly gross income of $525 gives you a gross rent multiplier of 114. And if the subject's property's monthly market rent is $600, multiply that by the 114 gross rent multiplier, comes up with the market value in use of $68,400. And the question is, what defines the monthly gross income and monthly market rent? and the person indicated they could get the sale price info. So monthly gross income would be the market rent as indicated by the market, along with any other sources of income. For example, for an apartment complex, you would think about not only the rent charged to the tenants, but are there other sources of income like revenue from washers and dryers, clubhouse rental, if there are pet fees, things like that. For a single unit property, you may not have other sources of income like clubhouse rental, obviously, or washer and dryer income, but there could be other sources. Maybe you do charge a pet fee. So as far as the monthly market rent, it is obviously dependent on market factors such as supply and demand, location. When working up Section 42 and 515 values, does the 5% rule apply to both? The real root of the question is that is a Section 515 USDA rural rental housing project also subject to using the 5% rule. We worked up the value that way, and they are arguing that it isn't correct. I'm at a loss here because it seems applicable to all low income, but the IC below is what they hang their hat on. So I mentioned that Section 8 and Section 42 are the two primary low income housing programs available. There is a Section 515 program, as you can see, and the Section 515 properties are those properties that are directly funded, say through loans or mortgages from the U.S. Department of Agriculture to nonprofit or for-profit rural housing developers. Since Section 42 deals more with the type of subsidized housing intended to assist low-income renters. This is going to be fact case specific. So it's difficult to say that that Section 515 properties, if that applies, the 5% rule applies to both. So having said that, that concludes the formal part of our presentation. And like I said, I wanted to leave enough time to have questions so that we can get into some more specifics or find out what's going on throughout the state in terms of questions. So Jenny, fire away, please.
Sure. We will use some of the questions that we had this morning because they were very relevant to the topic. But if you have any questions that you want to submit this afternoon, please enter them into the Q&A chat bubble, and we will get to those as we get through the list of ones we have. So the first one is, can the income approach appeal be used if financials were not provided before the assessment date?
Yes, and I'm going to click back to the Indiana Code provision. Again, a lot of times I'll refer to that if a taxpayer or an assessor or whomever sends a question in about a property, I will frequently refer to the Indiana Code provision. And in this situation from Indiana Code 6-1.1-4-39, paragraph D, you can see in the middle it says, however, the taxpayer is not prejudiced in any way and is not restricted in pursuing an appeal if the data is not submitted by the assessment date. So even, preferably, obviously, we would want the taxpayer to send in their income and expense information in a timely manner, but if they don't, they still can file an appeal. Next question.
Okay, the next one is, how are future apartment assessments impacted from the recent property tax legislation?
Good question, and that is to be determined. And by that, I mean the legislative session is still ongoing. They are scheduled or supposed to be done no later than April 29th, and so certainly a lot can happen in the next 13 days. And so there may be possible changes. We don't know. So until the legislature adjourns and if there was any potential legislation passed, it would be up to then the governor would have a certain amount of time to either sign the legislation, veto the legislation, or let the legislation become law without a signature. There's still a lot of things that could potentially happen. So with the legislation that was passed, Senate Bill 1 that was passed yesterday, or passed and signed into law yesterday by the governor, it's too hard to predict what may happen because there may be other changes that we don't know about yet. So stay tuned for future developments, so to speak. Next question.
Okay, sure. Our next one is commercial buildings depreciate pretty fast. Has there ever been talk about updating the economic life of such buildings?
Yes, in terms of one of the things we're looking at is updating, we will be updating our cost tables for the January 1st, 2026 assessment date. In fact, we have a meeting tomorrow with Wayne Moore, who is our vendor selected to help us with the cost updates to set up a schedule and plan for updating the cost schedules. But one of our goals along with that would be to update the depreciation schedule. That may not happen for the January 1st, 2026 assessment date. The cost schedules will be, but the depreciation schedule will probably not be updated by then. Hopefully, maybe it might be, but we do want to be able to look at all costs involved with apartment complexes, updating the cost, but also looking at depreciation, which could impact obviously the cost approach and what the bottom replacement cost, new less depreciation ends up being. So next question.
Okay, our next one, if we find on Zillow or a newspaper ad a higher asking price for rent, which number should we use? Example, a taxpayer says they get only $400 per month, but Zillow or the paper ad shows they are currently asking for $1,500 per month.
Good question. I know Zillow has certainly been a very popular tool for a lot of people to use, be it buyers, sellers, investors. I would be very careful in terms of using information from Zillow. And the reason I say that is it's being inputted by the individuals and that may or may not be 100% accurate. You don't know what necessarily may be put or included in that Zillow amount or say a newspaper ad. So I would urge caution when using that information. It very well may be a good source of information to help determine the valuation, but you would want to be able to look at other sources of information. Maybe going, say like if an apartment complex, going to their website to see what they they post or put as far as their rental amounts, or going to the property itself and getting brochures or information from the apartment complex or from the renter, find out. And also looking at Zillow, does it make sense? If somebody's saying it's $400 and another person says it's $1,500, why is there a big discrepancy? Why is there a difference? So it could be used, but like I said, I would be very careful in terms of what I use, because as we talked about the burden of proof, ultimately, the assessor has to be able to defend their assessments and to say, well, we got it from Zillow, we got it from this newspaper ad. That may help, but it's something I would not hang my hat totally on in terms of coming up with the value. I'd look for other sources of information or confirmation of that information that's posted on Zillow or in a newspaper ad. Next question.
Okay. In recent years, the effective year built has been changed, although no addition to complex numbers seem to be pulled out of the air. Does the assessor need to prove the effective year built decision?
Certainly, the assessor has the responsibility to defend their assessment, and if there's been nothing done to change the effective year or the effective date, that would, they could say we don't have anything to defend, so to speak. It is what it is in terms of the grade, condition, all of those things that go into the effective age or the effective year built. However, if the apartment complex or the rental property did do something to effectuate change, such as put a new roof on or new siding or new windows, then the assessor definitely would have to be able to defend or support that change in the effective year built or the effective age. We would urge that the assessor be consistent and fair and equitable in how they approach it. I know some counties have a standard operating procedure in place, what they say, thinking of now, not thinking of rental properties or how, apartments, but thinking of just individual residential properties. Maybe they have a system of process in place where if the taxpayer replaces the roof, then it changes the effective age by X, or if they put new windows in, it changes it by Y, or if they put new siding on, it changes it by Z. The same can hold true then for apartment complexes or for other rental properties that, using it as a guideline, they say, okay, for every apartment complex, when they get a new roof, it's going to change the effective year or effective age by 5 years, 10 years, whatever the case may be, or maybe it's looked at on a square foot basis for rental properties. So, long answer to a short question, yes, the assessor does have the responsibility to defend the assessments, all aspects of the assessment, including if there are any changes in the effective year built or the effective age. Next question.
Okay, we've got some questions submitted now. So we have a question as to factors applied to the DLGF cost tables. We have a taxpayer that is arguing changing the market factor from 0.90 to 1.00 is contrary to the law because we increased the factor. We read the law as there is to be no factors, therefore the 0.90 factor by law had to be removed and changed to 1.00.
Okay, there's a couple things working here, and so the assessor, the person is correct that the assessor shall use the department cost schedules. As you can see here in the bottom of paragraph F, the assessor shall use the department cost schedules without additional modifiers, adjustments, or other trending factors beyond the location cost multiplier adjustments developed by the department for the cost schedules used under this section. The use of locally developed cost schedules, location cost multipliers, and market or trending adjustments is prohibited. So part of this response is that for the January 1st, 2025 assessment date, we did update the cost schedules by changing what's called the verified economic modifier, the VEM, changed that from 70% to 100%. And by doing that, there were several property types that saw or had changes in their replacement new less depreciation because of that cost schedule change. And in some situations, the assessor, the annual adjustment for trending factor that they had to put on, maybe they, in prior years, maybe it was a certain percentage, and maybe because of the change in cost schedules that resulted in either a lower annual adjustment or trending factor put on, or no trending factor put on. So the assessor using our cost schedules would rightly be able to say the DLGF updated their cost schedules, and that resulted in the assessed value changing by whatever the amount may be. And as long as the assessor is using our cost schedules and not using any locally developed cost schedule information or modifiers, then that assessed value would then be reflective of what's in our cost schedules. Next question.
Okay. The income approach valuation performed by the assessor is supposed to be a market income approach, correct? So if
Correct.
A property has high vacancy, I assume you mean in relation to the market, an assessor is required to use the market, not actual vacancy.
Well, again, this is going to be property specific, property by property. So the assessor should be looking at the apartment complexes, and if an apartment complex has a high vacancy rate, the assessor should be looking into why is there a high vacancy rate? Is it because the the apartment owner, the developer is charging, rents that are far and above, what other comparable properties are charging? Is it because the high vacancy is due to the condition of the property and that it's not desirable, that people are leaving, that apartment complex or property for another one just because of the condition or maintenance upkeep? So there are a lot of things that go into why there is a high vacancy rate, and the assessor has to do some digging, so to speak, to find out what's causing it. But if it's just because of supply and demand, for example, maybe in the jurisdiction there are too many units, and that's driving the vacancy rate. So it really just depends on the situation and looking at what's driving or what's causing high vacancy rates, which then would translate into lower income, which could then result in, or is it, management practices could be another reason for a high vacancy rate. So the assessor has to look at all facets of the income and expense information and do an analysis and see, what is the vacancy rate, in their jurisdiction. Most vacancy rates range anywhere from, say, 5 to 10%, but if a property had a vacancy rate at 25 or 30 or 40%, certainly if I were the assessing official, I'd be asking a lot of questions. Why is there such a high vacancy rate? So another long-winded answer to a short question. Next question, please.
Okay, I think that this person was possibly replying back to in regards to the apartment, the Zillow versus rate ad in the paper. So it says the statute requires taxpayers to provide documentation. So I would recommend getting rent rolls and or profit and loss statements from the taxpayer and not just relying on word of mouth for third-party websites. Additionally, the income approach requires use of the market rent. So I'd argue that assessors are not tied to having to use the actual rent, especially if it's proven to be above or below market.
Okay, sounds reasonable. Sounds realistic. So, okay.
Okay, thank you for all of those questions. If you have any more, let us know. We'll jump back to some of our other ones that were previously submitted. So assisted living complexes valued from the apartment schedule will still receive market factors versus a 1.0 factor.
Correct. So back to what I was saying just a minute ago about the properties, you have to look at the property when we get to the assisted living. Yeah, I misplaced the information on assisted living, but in terms of looking at the assisted living facilities, you certainly need to look at all the sources of income and then go from there. So a non-answer answer. Next question.
Okay. Here we have, is the, with the apartments, is it more than 4 or 4 or more?
Okay, that's a good question. And 6-1.1-4-39, when we started, I indicated or stated that you can see in paragraph A that it states that to rent or otherwise furnish residential accommodations for periods of 30 days or more, and that has more than 4 rental units. And then the gross rent multiplier method is for 1 to 4 units. So anything above 4 units would be, using the lowest valuation approach, the 3 approaches to valuation.
Okay, our next one is the income approach value for Section 42 properties based on the actual operations of the subject?
Yes. Keep that answer short.
Okay, and then 2 more questions here, and then we'll get wrapped up. Will you be changing the property class 401 to 5 to 19 family apartments since 4 isn't included in the same rules for assessing?
Yeah, so that question came up, and it's a situation where any changes like that, we would have to go through. I'm double checking with our information systems director and our legal counsel, but I believe it is something we would have to go through the rulemaking process to change that 4 units to 5 units. So I think it's not as easy as it sounds to just change it from one to another. We'd have to go through and do some changes in terms of the rulemaking process. The last question.
Our last question, should we expect an increase in cost tables for 2026?
As I mentioned, we are in the process of meeting or starting to meet, and there's always a possibility that the cost table can go up, and especially since the last cost table update, other than the BEM for the January 1st, 2025 assessment date, the last update was in 2022. And so if you think of prices for goods compared from 2022 to 2026, chances are those prices have probably gone up, but that does not necessarily mean that all prices or all costs will go up. Some may go up more than others, some may go down. So that's something we'll be working on in the next 7 months to be ready for the January 1st, 2026 assessment date.
Okay, that wraps up all of our questions for today. Thank you all for participating in the webinar today. We will be sending out an email that will have the PowerPoint, the PDF version, the video, the CE form, and we will send those all out to you later this week. So please watch for those as they will be emailed to those that were pre-registered, and they will also be on the DLGF website and on the DLGF YouTube channel, so you can find all of that information. Feel free to share it with your employees or your team members, especially those that may be working with this topic and want more information. Again, this course is valid for 1 hour of CE credit. If you want CE credit and you're an assessor, you will need to self-report that on the CE form and then submit that to our education inbox, which is education@dlgf.in.gov. It is also on the form, so just fill that out and submit that. If you are a different elected official or staff member and you want CE credit, please reach out to your governing body or association and find out how you should submit your CE form, or if you should retain that in your files. So we want to again thank you all for participating again, and we hope to see you in May at our next webinar. Thank you.